Bismillahirrahmanirrahim. Assalamu alaikum, good afternoon. This is our last session in the series of IAS and IFRS. And I suppose this is the 10th session. And in this session, we shall cover International Accounting Standard 12. And that standard will be covered in a practical manner. And before we start discussion on the International Accounting Standard 12, for those members who have joined us only for this session, very brief introduction. My name is Muhammad Abu Bakr. I'm a fellow member of ACCA and associate member of Institute of Chartered Accountant of Pakistan. And I have diversified post-qualification experience of about 13 years of performing leading roles in the practice areas of audit and assurance, business advisory services, not only in Pakistan, but also in the Republic of Yemen and Republic of Mauritius. I deliver trainings to the professionals, including partners of 2 renowned firms of Mauritius. And I am a CPT trainer for Mensa region for ACCA on auditing standards and IFRS. In addition to being a partner of Bekatili Mahmood Idris Kamal, I am a visiting lecturer at CFE group of colleges here in Pakistan and BSB Mauritius. Then I authored a book on IFRS titled IFRS Application Guide, which was issued in last October 2015. That covers almost all standard, but that is written in an from practical point of view, that how you can apply a standard. Though technical jargons are included in that book, but I have tried to minimize the use of technical jargons because the basic objective of that book was to convey to the advanced level students and the professionals that how they can apply the standards. So, few instructions which you people should keep in mind. So you should have a notebook and pen ready, because this session will involve small calculations, as in case of our previous sessions. We normally discuss the concept with the help of small illustrations. So the same way, I shall be using various illustrations to explain the concept. So that's why it is helpful for you people to do some calculation along with me, so that you could be able to revise this important area and you could get maximum benefit out of this session. So be attentive. As I usually said, having toffees or chocolates can help, but because so many concepts are tightly linked with each other, so a point may not be understandable if the related earlier concept is not appreciated. Members and other professionals sitting in groups should not start commenting until the session ends, otherwise this will impair the hearing of others in the group. You can ask questions. Of course, we shall be having frequent question answers break, and I shall try to answer as many questions as possible. Today, again, I am running this webinar from my office. So, okay, let's start this webinar. Yes, these slides, these slides need to be uploaded. You are seeing the
Yeah.
slide. This
How
this one and this
the question IAS
one. Once these are uploaded, can they download from there or not?
they can
Then only these two. This one and this one.
this one.
Yes. So we have uploaded two handouts on the GoToWebinar website. Okay, International Accounting Standard 12, income taxes. There are three concepts. One is very simple concept, current tax concept. What is current tax? When a taxman calculates the taxable profit from your available information, and thereafter, when he will apply the tax rate to the taxable profit, this will give you the current tax. Simply the current tax liability means you have an accounting profit and accounting those adjustments which you made while calculating the accounting profit, tax people may not agree with those adjustments. So as a result, they may make certain changes or they may allow certain adjustment and they may disallow certain adjustments. So as a result, tax people will be calculating their own profit, and that profit is normally termed as taxable profit. Whenever you apply the tax rate to that taxable profit, this will give you the current tax. So this is a very simple concept of the current tax. Then is the concept of the income tax expense. So there is a difference. Current tax could be your income tax expense, or your income tax expense could be more than or lower than your current tax figure. So we shall be discussing, first of all, with the help of example, that how normally we calculate the current tax. See what happens, some expenses or income which are not being allowed in a particular year, they may be allowed subsequently. So because we as an accountant have to follow the accrual concept, so we normally include those income and expenses in the calculation of our accounting profit. But when tax people see those profits, so they normally readjust those profits in order to calculate their taxable profit. So this is the concept of the accounting profit and the taxable profit. Only the difference is because we prepare our accounting profit as per accounting principles, which could be international financial reporting standards or US GAAP or other standards. Whereas taxable profit is calculated based on the principles given in the tax law. So as a result, these two profits could be different. So current tax is calculated by multiplying the tax rate with the taxable profit. So what is the concept of the deferred tax in fact? If an expense is allowable under your accounting principle, but that expense is not allowed by the tax authorities, and they will be allowing it maybe sometime in the future. So when they will be calculating the taxable profit for this current year, they will be excluding that expense, but they will be allowing this expense sometime in the future. So when they will be allowing that expense, of course, in that future year, you can include that expense for the calculation of the taxable profit. So this means if an expense is disallowed during this year, tax consequences will arise ultimately in the future years. So this means you will have to take into account those future consequences now, because we are applying accrual concept. Under accrual concept, we calculate our profit on incurrence basis. If an expense is incurred, so that is our expense, and that will be taken into account in the calculation of our accounting profit. Because tax people are not allowing that expense now. So this means our taxable profit will increase because they have not included that particular expense in the calculation of the taxable profit. So now when taxable profit is increased, when we will be multiplying tax rate with that taxable profit, this will give us the current tax payable. In fact, we are paying more, but in the future year, when that expense will be allowed, in that year, accounting profit will not be calculated, will not include the effect of that expense, but only the taxable profit will include the effect of that expense. This means in that particular year, the taxable profit will be lower than the accounting profit. So as a result, we will have to pay a lower amount of tax as compared to the amount which should have been paid. So that that shortfall is basically equal to the amount which we have paid more in the current year. So this is in fact the concept of the deferred tax. Okay, we shall discuss this concept with the help of two examples. So if you will go along with me mentally, so we shall be able to appreciate the basic concept of the deferred tax. Example 1. In this example, fixed asset cost is equal to 75,000. Accounting depreciation is equal to 20% straight line. Residual value is equal to nil. Assume accounting profit before tax is 80,000 per annum. Capital allowances or tax depreciation is equal to 50% in first year, 25% in second year, and 25% in third year respectively. So this is the depreciation rate with reference to the tax people, and this is the depreciation rate with reference to the accountant. Now, what will be the situation? The situation will be, from accountant point of view, in year 1, this is the accounting profit before tax. And so when we shall apply the tax rate to this amount, this will give us the taxation based on accounting profit, and this will become the profit after tax from accountant point of view. And likewise in year 2, because we have assumed that in each year the profit will remain the same. Likewise in year 3, year 4, year 5, and here is the total. Okay. So we should keep these figures in mind, but because handouts are uploaded, so it is better you should download that and make your this should be in front of you so that you could be able to appreciate the figures when we move to the next slide. When a tax person will calculate, in order to calculate the tax, what he will do, first of all, he will take your accounting profit before tax. He will add back your accounting depreciation. He will add back your accounting depreciation because here in this case, our accounting depreciation is 15,000. 15,000. He will add back this accounting depreciation. This will give him tax, and he will deduct tax depreciation, which we assumed in our example 1. That is, this tax depreciation is in first year. This is the I suppose this is the 50%. Yes, this is 50% of the cost of the asset. Cost of the asset is 75,000. So 50% will comes to 37,500. And then this is the taxable profit. We saw in the earlier slide the profit for profit after tax for from accountant point of view, and accounting profit before tax from accountant point of view. That was 80,000. But from tax point of view, taxable profit will be 57,500. So tax rate will be applied to this figure. So this will give us the current tax for year 1, and 40,250 will be the profit after tax as per the tax law. Okay. In year 2, accounting profit before tax, and again we shall add accounting depreciation of 15,000. So this will give us, and deduct depreciation with reference to the tax law, which is 25% in the second year. So this will give us the taxable profit 76,250. Again, we shall apply the tax rate to 76,250. This will give us current tax for year 2. So this will give us profit after tax. And in year 3, similarly as we done in year 2, but in year 4, see, in year 4, this is the accounting profit before tax. We added the depreciation here, but in year 4, because from tax point of view, the asset has already fully depreciated. So in year 4, no depreciation charge will be deducted, because from tax point of view, this asset has already been fully depreciated. Then this will give us the taxable profit, and this is the tax. This will give us the profit after tax. And then in year 5, the same situation, because it is fully depreciated. But when we see the total, picture over the life of this asset, we can see that over the life of this asset, we earned the same profit. We earned the same profit as we calculated in case of accountant. In case of accountant, if you go back to the earlier slide, we can see that there. See, please note that accounting profit before tax is 400,000. Taxation based on the accounting profit is 120,000, and the profit after tax from accountant point of view over the life of this asset is 280,000. So please remember these three figures: 400,000 accounting profit before tax, taxation based on the accounting profit 120,000, and profit after tax 280,000. See, when we see here, the total is the same. Here you can see that taxable profit is 400,000. Tax over the total tax over the life of this asset is 120,000, and profit after tax is 280,000. Both are same. This means when an accountant calculate or when a tax person calculate, cumulatively, both will reach to the same figure. So what is the difference? The difference is the timing difference. Accountant is charging depreciation over a period of 5 years. So that is affecting the calculation of the profit from accountant point of view. Whereas the tax person calculating the depreciation based on the tax law on a different pattern. So as a result, over the life of an asset, because of the difference of the charge of depreciation between the accountant and the tax person, in each year, there may be a difference between the profits calculated by the two. But cumulatively, if we see the overall picture, if we see the results over the whole life of the asset, both ends up with the same figures. So this means over the life of the asset, in any particular year, the accounting profit and the tax profit will be different just because of the difference in the way that this particular expense is being allowed. So what happens? Because we as an accountant, if we just compare it, we as an accountant, see, this is the in year 1 situation. This is year 2 situation from accountant point of view. And the same is the situation here. See, but if we just compare year 1, those boxes which are shaded in green color, they are basically accountant workings, and those boxes which are shaded in pink, I suppose it is pink, those are from tax professional point of view. See, in year 1, from accountant point of view, the tax should be 24,000, and whereas from tax person point of view, it should be 17,250. And we know why it is so, because the depreciation allowed by the tax authorities is 37,500, whereas on the same asset, accountant charged the depreciation equal to the 20% of the cost of that asset, which is 15,000. So as a result, accountant profit is higher, whereas the profit calculated by the tax person is lower than the accountant profit. So as a result, tax calculated by using the tax law is a lower figure than when we calculate the tax by using the accountant figure. But what we will do, because we know that using accrual concept, this is our real tax liability. Why? Because this expense will ultimately reverse. This expense, see, you can see that in year 4 and 5, as per tax law, there is no depreciation, whereas accountant continues to depreciate its asset in year 4 and 5. So what an accountant will do, the difference between these two texts. So this will be the current tax. As we learned, I narrated the definition of the current tax right at the start, that this is the tax. Current tax is basically calculated by applying the tax rate to this taxable profit. Taxable profit, a profit calculated by using the tax law, by adjusting the accounting profit, by applying the tax law on the accounting profit. So that will give us taxable profit. So this is the current tax, 17,250. So the difference between these two is basically, the difference between these two is 24,000 minus 17,250, 6750. 6750. This is an expense. Okay, now we have slate with us, so I can use the pen to make it more easier for me to explain and for you to understand. It's working. It's working. Working. Start working, but it will take some time. Okay. See, this is the income tax expense as per accountant, and this is the current tax payable. Current tax using tax law. The difference between these two we just calculated is 6750. The concept is very simple. See, if your rental expenses, say 12,000, and you have only paid 8,000. So what will be the treatment of the difference? That is 4,000. That difference will become your liability. That difference will become your liability. And this liability will appear under the liability section of the balance sheet. The same is the case here. In fact, your tax is 24,000. Your tax is 24,000. This is your expense. This is your expense as calculated by the accountant. But in fact, you are paying only 17250. And the difference is 6750. This means 6750 worth of expense has not been paid. So the same concept we will apply here. An unpaid expense will become your liability. An unpaid expense will become your liability. Only just to differentiate it from other liability, we mentioned with it tax liability and nothing else. This is the same concept. In case of any other liability, any amount of expense which is unpaid by the year end, that will become your liability. Likewise, on using accrual concept, this is our income tax expense because this is our profit. So this is our income tax expense. This is our profit. So in fact, we are paying 17,250 for whatever reason, because of tax law or whatever reason. We are only paying 17,250. So we are not paying the full expense. So the difference will become our liability. Just in order to differentiate from the other liability, we add the word tax liability. And further, this will be paid in the future. So another term is added to this, deferred tax liability. This reflects that this is not current tax. This deferred word reflect that this is not a current tax, that we are not going to pay within a period of next 12 months. This will be settled somewhere in the future. This will be settled somewhere in the future. Just to differentiate from current tax liability. See, this is also a term. See, current tax liability. What is the current tax liability? 17,250. But if we say 6750 as also tax liability, so in order to differentiate between these two, we added the word deferred tax liability, that this amount will be paid, will be settled after a period of more than 12 months. So this will become our, so this is not the current tax liability. So I'll repeat the whole situation. See, when there is a difference between the pattern, how the expense is being allowed by the tax authority and how the expense is being charged by the accountant, this will create the difference between the taxable profit and the accountant profit. So, but as we have learned from this example, this difference over the life of that asset will no longer be there. When we see the results over the life of that asset, the result will be the same. Whether you calculate from tax point of view or whether you calculate from accountant point of view. When the results are the same, so this means, but when we calculate on year by year basis, so we need to record certain amounts. Like in year one, our total income tax expense was based on accrual basis. This was 24,000, whereas tax people current tax liability was calculated based on the taxable profit was 17,250. So this is our expense, in fact, income tax expense. We use the term income tax expense. This is our expense. In the simplest form, of course, other concepts will be added to this, but in the simplest form, this is our income tax expense. But in fact, we shall be paying 17,250. What does it mean? We are not paying the whole expense. The difference is our liability. Only just to differentiate from other liability, we added the word tax. And then to differentiate this tax liability from this current tax liability, we added the word deferred. So this is deferred tax liability. Okay? So please remember this. This is deferred tax liability. Likewise, in second year, this was our income tax expense, and this is the current tax payable. Here, again, we are not paying the full amount. So this will give us 24,000 minus 22,875. So this will give us 1125. So this will be the liability for second year. In first year, the liability was 6750. And in second year, we have not paid the whole amount of expense. So as a result, this will become our deferred tax liability. And if we want to see the cumulative picture, 6750 plus 1125 will give us the cumulative deferred tax liability at the end of the second year. Then in the third year, the situation is the same. For third year, again, you are paying a lower amount than your income tax expense. This is your current tax payable, which is lower amount calculated on the basis of taxable profit. So this is again the lower amount. The difference between these two is 1125. This difference will again add to the deferred tax liability. But in year 4, the situation is reversed. This is your expense, whereas you are required to pay the current tax 28,500. So you are paying more. So what happened? In fact, in first 3 years, we were paying less. So that shortage is being reversed now. That liability is being repaid. For example, in year 4, you have paid 4,500 lower than your expense. But in fact, we know that this 4,500 relates to these 3 years where we have paid lower amount than our expense. And similarly in year 4, so this is being reversed. Okay, next move to the next slide. So our conclusion from this slide is, number 1, profit as per tax return, taxman is not always equal to the accounting profit. Tax amount based on the taxable profit is not equal tax as per the accounting profit. Cumulatively, profit, tax, and profit after tax are same, mean these are only the temporary differences. And if we are paying expense less than it should be, this will result in the deferred tax liability. In fact, this will result in the liability, but we added 2 words just to differentiate. We added the word tax in order to differentiate from other liability, and we further added the word deferred in order to differentiate it from the current tax liability, which we calculated based on the taxable profit. Okay, now we move to the next slide. Next is, see, in year 1, these were the tax. These were the tax as per the tax law. And in year 1, this was the tax based on accountant. This was the tax based on accounting profit. So deferred tax will be equal to 6750 as I explained in my earlier slide. Here 1125. This will be the deferred tax. In this case, it is liability. Why? Because your expenses is a higher figure and you are paying a lower figure in first year. So the shortage will become your liability. So this is liability. This liability is for year 1, this liability is for year 2, this liability is for year 3, and this is the reversal of this liability. So this is the reversal in year 4 and this is the reversal in year 5. The net result will be nil. So this is the concept of the deferred tax liability. What are the learnings from example 1? Number 1, current tax is the amount of income taxes payable in respect of the taxable profit for a period. This is first learning. Second learning is that deferred tax liabilities are the amounts of income taxes payable in the future. See, like this was the deferred tax liability for first year. This was the deferred tax liability for second year. This was the deferred tax liability for third year. If we add all these 3, by the end of third year, deferred tax liability totaled to approximately, I suppose, 9,000. So in year 4, this was reversed. And in year 5, it was further reversed. This is not asset here because there is a liability. So this is a reversal of the liability. This is a reversal of the liability. In total, the situation will become nil. So in its simplest form, in example 1, income tax expense was equal to current tax plus deferred tax liability. In its simplest form. So income tax expense was, see, when you add these 17250, 6750, this will give you the income tax expense. In second year, in third year, in fourth year, in fifth year, same. So if we look at this example with reference to statement of financial position, with reference to the statement of financial position. So what will be the presentation? See, property, plant and equipment, year 1, 60,000 from accountant point of view. This is after deduction of 15,000 depreciation in first year. But from tax point of view, because under tax law, first year depreciation will be the 50% of the cost. So from tax point of view, the carrying amount of this asset will be 37,500. So this is the difference, 22,500 between these two figures. When we apply the tax rate to this figure, so this will give us the deferred tax liability. This is the same as we have calculated from the profit and loss. But remember, when we calculate the deferred tax from profit and loss account, that will be related to that particular year. But whenever we calculate the deferred tax with the help of statement of financial position, this will give us a cumulative picture, like in year 2. So here, this is the deferred tax liability for the year, because this was the first year. So that's why for the year, deferred tax and the closing balance are the same, because the opening balance is 0. In year 2, from accountant point of view, the asset will be further reduced by 15,000, and this will become 45,000. And tax base, because in second year, 25% is the depreciation rate in second year. So the carrying amount from the tax point of view will become 18,750. So the temporary difference between these two figures will become 26,250 when we apply 30% on this. So this will give us 7,875. This is, in fact, the closing deferred tax liability at the end of second year. Because we saw in our earlier slide that in the second year, this is our basically deferred tax liability for related to the second year. But because we calculated this deferred tax from balance sheet, so this will give us the cumulative picture. Likewise, in year 3, accounting profit is 30,000 after charging 15,000 of depreciation. And at the end of third year, the asset is fully depreciated from tax point of view. So the carrying value of this asset will be 0 in third year. So temporary difference will become 30,000. So when we apply 30% to this amount, so this will give us the 9,000. So again, 9,000 is the cumulative picture at the end of third year. And in third year, deferred tax liability for that particular third year is 1,125. So this is the cumulative picture, in fact. So when we add all these three, this will become 9,000. And in year 4, see, this was the carrying amount, and again, carrying amount of the asset from tax point of view is 0. So this will give us the temporary difference, and this is our basically deferred tax liability at the end of the fourth year. Why this is so? Because this was reduced by the 4,500 in year 4. And likewise in year 5, see, this has become 0. Why we term it as a temporary difference? Because over the life of the asset, this will disappear. Over the life of the asset, both will become equal. So this is only a matter of time. So that's why we term it as a temporary difference, because this will be reversed over the life of the asset. This is only a temporary difference. We are paying a lower amount of tax only temporarily, because subsequently we will have to pay more tax than calculated based on our accounting profit. So this is only a matter of time. So one expense is being allowed now, it is or it is not being allowed now, and it will be allowed sometime in the future. So this is only a matter of time. So what is the conclusion from statement of financial position? The conclusion is statement of financial position Let me use pen here. Statement of financial position gives statement of financial position. We shall be having a question answer break after this slide. So if you have any question, please make up your mind, and I shall be answering your question after after discussing this slide. Gives us cumulative deferred tax position at the end of that particular year. Number one. Number two, normally the difference between closing, okay. Second is when carrying amount is higher than the tax base for an asset, when the carrying amount of an asset is higher than the tax base. Tax base, carrying amount of that asset calculated using the tax principles, using the tax law. So this difference will be termed as taxable temporary difference. And when we multiply this difference with tax rate, this will give you deferred tax liability. This will give you deferred tax liability. Okay, so this will give you the deferred tax liability. And taxable temporary difference will result in the payment of. Why we termed it as taxable temporary difference? Because this will result in the payment of tax in the future. If you just go back to the previous slide, see here, this is the temporary difference. This is the temporary difference. This. So this is generating liability. As a result of this difference, we will have to pay this tax sometime in the future. So that's why we term this temporary difference as a taxable. So what we learned from here, when the carrying amount from accountant point of view is higher than the value of that asset calculated using the tax law. If it is a higher figure, the difference will be termed as, please note, taxable. Why we term this difference as a taxable temporary difference? Because when we apply this tax rate to this amount will have to be paid, and we paid it this amount a part in year 4 and a part in year 5, because this difference will create deferred tax liability. So that's why we term this temporary difference as a taxable temporary difference. This means taxable temporary difference will generate deferred tax liability. Okay. Do we have any question, Ms. Bilal? No problem. I will try to answer them. lesson we are going to discuss very shortly. Of course, inshallah, we will try to discuss maximum aspect of deferred tax. See, this is only an estimate. So, like this is only, I mean, you will be recognizing it as an expense. You will be only recognizing it as an expense. If you are required to pay more tax, so that will be only an adjustment in your that particular year expense. Next. Mohammed Mansoor, 24,000 is the calculation based on accounting profit, and uh, tax is paid uh, on the basis of taxable profit. So in fact, we are paying 17,250, not 24,000. So that's why this will create deferred tax liability. Mansoor, I hope it should be clear. Next. Okay. So let's move to another example. Another example is for the same asset, but I reverse the situation. Fixed asset cost, same 75,000. Accounting depreciation, 50%, 25%, and 25% of the cost in year 1, 2, and 3 respectively. And residual value is equal to nil. Let me convert it to the arrow. Okay. So assume accounting profit before tax is same. Capital allowances are 20% straight line. So now I reverse the situation just to see what happened. From example 1, we learned 3 things. If carrying amount of the asset is a higher figure than the tax base, mean the value of or the carrying amount of the asset with reference to the tax law. If it is a higher figure, this will create taxable temporary difference. And when we multiply that taxable temporary difference with the tax rate, this will give us the deferred tax liability. This was one thing. Second, statement of financial position gives us a cumulative position of deferred tax, whereas profit and loss account gives us the position for that particular year. Number 3, current tax payable will be calculated based on the taxable profit, and the amount which will be actually paid is the current tax payable, which was calculated based on the taxable profit. Tax calculated based on accounting profit is only for the sake of calculation, just to see what is the expense. What is the expense? Okay. Here, in this case, from accounting point of view, the picture will be the same as we saw earlier. Picture will be the same. And then from tax point of view, in year 1, now this is the accounting depreciation. So the tax person will reverse this depreciation, and this will give you, he will allow you to deduct from this profit the tax depreciation. So 102,500 will become the taxable profit. Mr. Mansoor, here is the important point. The amount you will pay to the tax authority for this year 1 is based on this figure, which is the taxable profit, and this is termed as normally current tax payable. This is current tax. This is current tax. Okay, in year 2, Likewise, he will be adding back accounting depreciation, and tax depreciation will be reduced from this amount. This will give us 83,750, and current tax payable will become 25,125, and this is profit after tax. And then year 3, 80,000, and likewise they reversed the accounting profit here, and here you can see that they allowed you to the tax profit. And likewise in year 4, from accountant point of view, no depreciation was charged. From accountant point of view, the asset was reached to the zero value. And in year 4, this is a hypothetical situation. Please don't criticize the numerics of the example, because normally if an asset has a life of 3 years, so that will be of course cannot be used over a period of 5 years. But however, this is a hypothetical situation when we just to understand the tax implications. See here we can see that the same situation. This is from tax people point of view. Here you can see that this was the accountant situation. The data appearing in green is the accountant situation. See, in year 1, you can see that from accountant point of view, the tax expense is 24,000. This is not the amount which is paid to the tax authority. This is from the accountant point of view. Whereas the current tax payable is, which will be paid to the tax authority, is 30,750. So it is more than the income tax expense. So the concept is very simple. If you have paid more than the amount of expense, so that will become your asset. Like normally you say this is a prepayment. Like if you paid more rent expense, like your rent expenses, say your rent expenses 12,000, and you paid like say 15,000. So you paid 3,000 more. So this is only your asset, nothing else. The same concept will apply here. As per the accountant, this is your expense. As per the accountant, this is your expense. Whereas for whatever reason, but here the reason is the tax law, you are paying 30,750. So what is the difference between these two? So you are paying more. How much? 3750 minus 24,000. So you are paying 6750 more. So this will become your asset. This will become your asset. Only to differentiate this asset from other asset, we add the word tax. And there could be current tax asset. So in order to differentiate from that asset, we added the word, this is a deferred tax asset. This is a very normal asset. Simply, if you are paying more than your expense, so the excess amount will become your asset. I want you, or standard want you to add two words to this asset, tax and deferred. Tax obviously just to differentiate from the other type of assets, and deferred mean this will be paid roughly after 12 months. That's why this asset is termed as deferred tax asset. So in year 1, this will be the deferred tax asset. Next is in year 2, the situation is more or less same. In year 3, in year 4, in year 5, and this is the total. But if we compare the total, here and here, cumulatively the picture is the same. So this means this is only a temporary difference, which reversed subsequently. See, in year 4, your expense is 24,000, whereas you are required to pay under tax law 19,500. This, in fact, is the reversal of these calculations. And in year 5, this is further being reversed. Okay. So this was the conclusion. See, from tax point of view, these were the current tax payable, current tax amounts, current tax payable, calculated by multiplying tax rate to the taxable profit. Whereas, from accountant point of view, this should be the tax, this should be the tax, this should be the tax, though cumulatively both are same. But here we can see that because here in year 1 we are paying more, this will create 6750 asset, 1125 asset. But we learned from earlier slides that this asset is basically related to this year 2, because we are calculating this deferred tax asset from profits. So when we calculate deferred tax asset or deferred tax liability from the profit and loss account, this will give us the current figure related to that particular year. And in year 4, this is being reversed. In year 4, this is being reversed. At the end of the life of the asset, both will be the same. So what are the learnings from example 2? Number 1, current tax. It's the same current tax is the amount of income taxes payable. This is repetition. So here we can see that this was our current tax, and deferred tax liabilities are the amount. So here I would say deferred tax fees, deferred tax assets are the amounts of the income taxes recoverable in the future periods. Here is some typing mistake, but I have corrected over here. Deferred tax assets are the amounts of income taxes recoverable in the future period. Further, as if this was the deferred tax asset in first year, this was in second, this was in third, and here it is being recovered, and here it is being recovered. This way. So in a very simple form, income tax expense is equal to current tax minus deferred tax asset. So the income tax will become first year 30,750 minus 6750. This will give us 24,000, 24,000, 24,000, and likewise. Then, if we just look at this example with reference to the statement of financial position, the situation will be property, plant, and equipment under non-current asset, year 1. The carrying amount from accountant point of view will be 37,500 after charging 50% depreciation, and from tax people point of view, this will be 60,000. See, this will create again a difference. When we multiply this difference with 30%, this will give us 6750. See, but this 6750 will be recovered in the future as we recovered it in year 4 and 5. This will result in the saving of the tax in the future. We have paid more. So this means this temporary difference can be termed as deductible temporary difference, because when we multiply tax rate with this difference, this will give us the amount that will be deducted in reaching the taxable profit for the future, which will be deducted in reaching the taxable profit for future years. So that's why we can term such difference as a deductible temporary difference. So here we can make another principle when the carrying amount as per accountant is lower than the carrying amount as per the tax law. Tax base means carrying amount of that particular asset or liability as per the tax law. If it is higher figure, this will result in that deductible temporary difference. So in year two, you can see that carrying amount is 18,750. We shall be having a break after approximately 23 minutes. Approximately after 23 minutes. Okay, so this is year two, 45,000. And this is the tax base, and this is the difference. This will give us 30%. And this is basically 7875. This is the cumulative picture. And if we add these two, so this will give us 7875. But balance sheet, as we learned earlier, this will give us the cumulative picture. Similarly, in year three, from accountant point of view, because we have fully depreciated this asset by the end of year three, so tax base is 30,000. So this will give us this difference. So this is 9,000. And if we add all these three figures, this will give us 9,000. And in year four, you can see that initially it was increasing. Now it is decreasing. Now here it is decreasing. So why? Because this is being reversed. And in year five, so total this will become 0. So what is the conclusion? The conclusion is, first, again, the statement of financial position gives us the cumulative picture. Then second is when carrying amount, carrying value, or carrying amount of an asset from accountant point of view, is lower than the tax base. And how can we define tax base? This is the carrying value or carrying amount of asset or liability, of asset with reference to tax. So this difference will create deductible temporary difference. Deductible temporary difference. And why deductible? Because the multiple of this deductible temporary difference and the tax rate will give us an amount which will be deducted while calculating the tax payable for the future years. That's why this will generate deferred tax asset. So if we have any question, I can answer now before concluding my so far discussion.
We do have some questions.
If you people have any questions, please ask now before I conclude. Okay, we can move further. Meanwhile, if you have any question, feel free to ask.
The first question is from Samir Al-Ghanan. If we have a deferred tax asset and a deferred tax liability, shall we present them separately or net them together?
You can net them together if offsetting criteria is being met. Normally, we net them off.
Next is from Shayan Ahmed Qureshi. What will be the accounting entry for recording of tax expense? Shall it be direct tax expense accounting point of view, credit current tax and credit deferred tax liability?
Who is this gentleman?
Shayan Ahmed.
Shayan, see, in example 1, I will be passing only year 1 and year 2 entry. Hopefully, when I'll be discussing the remaining illustrations, the entries will appear there. Anyway, in case of example 1, see, Example 1. I'm saying example 1, year 1. Example 1, year 1. So income tax expense mean profit and loss. Income tax expense. So I can use, so I need more space here. So debit, profit and loss, income tax expense, income tax expense account, and this will give us 24,000. This was the amount. I am blessed with another computer, so this is in front of me on the screen of another computer. This is 24,000, year 1. And what was the current tax payable? Current tax payable year 1, this is 17,250. 17,250. This was the amount. And the balancing amount will become our liability, deferred tax liability, which is, I suppose, 6750. Cheyenne, I hope it should be clear, 6750. So this will be our liability. So this will be the entry for the first year, likewise in second, likewise in third. And then in year 4, this will start reversing. Income tax expense will remain 24,000, but this deferred tax liability will start, we will start crediting this deferred tax liability. Who is this gentleman? Nasir, inshallah, we shall be discussing very shortly. Okay, I'm going to summarize it because this slide, I will be mentioning certain rule of thumbs. So I would request all the respectable members, so please, if you can note this on your notebook, so this these will be helpful. Okay, so let me raise this from here. Raise all income slide. So what are the learnings? So what is the rule of thumb? Rule of thumb. Number 1. Rule of thumb. Once the principle is, once we learn a rule, so please memorize that. We do not need to reinvent the wheel again and again. For asset, if the carrying amount of the asset from accountant point of view is higher than the tax base, this will generate taxable temporary difference. Taxable temporary difference. And when we multiply these taxable temporary differences with the tax rate, so this will give us deferred tax liability. So I'm using D for deferred, T for tax, L for liability. Second, if we reverse this situation, if the tax base is higher amount as compared to the carrying value with reference to the accountant, this will give us deductible. This will give us deductible temporary difference. And when we multiply this deductible temporary difference with the tax rate, this will give us D. I'm using for deferred tax asset. This situation we saw. This situation we saw in case of example 1. And second, we noted in example 2. Now, for liability, the situation will be reversed. The situation will be reversed. Liabilities. Liabilities. If carrying amount of the liability from accountant point of view is higher than the tax base of that liability, this will create deductible temporary difference. Deductible temporary difference. Deductible temporary difference. And when we multiply deductible temporary difference with the tax rate, this will give us deferred. I'm using capital D for deferred, not deductible, because I'm writing the full word deductible. When I'm using D, capital D alone, this represents deferred tax asset. So you can see that this is exactly the reverse situation in case of asset. This means if you just memorize asset, liability is only reverse of asset situation. Even if you just memorize only this first. So for asset, this will be a reverse situation, and for liability, both situation will be reversed. So tax base, this will give us taxable temporary difference. Taxable temporary difference. So when we multiply tax rate, this will give us deferred tax liability. This is the rule of thumb. So it is better you should note it. Now, so far, what we learned, the real thing is the tax base. If we could calculate the tax base of any asset and liability, now I'm moving my discussion from the typical fixed asset to the other assets and liabilities. So the important thing is the determination of tax base. Determination of tax base. So what is tax base? We all know that. I just wrote in some earlier slide that tax base of an asset, the tax base of an asset or liability, the tax base of an asset or liability is the amount attributed to that asset or liability for tax purpose. So the real learning is how to determine, how to reach to the tax base. If we can do that, so this means more than half of the standard is easy. I would not say 100% of the standard become easy, but this will substantially resolve your misunderstandings about this standard. Okay, what is the definition? This is the repetition of the definition. This is the deferred tax definition. So let's look at a few definitions before moving further. Current tax. The current tax is the amount of the tax income tax is payable or recoverable in respect of the taxable profit or loss for a year. In case of loss, this will be recoverable. In case of profit, this will be payable. So this means this could be either current tax payable or current tax asset when it is recoverable. Current tax assets. Deferred tax. Deferred tax is not a current liability to the tax authority, but rather an accounting adjustment. So because this will be settled sometime in the future. Deferred tax liabilities are the amounts of income taxes payable in future periods in respect of the taxable temporary differences. And deferred tax assets are the amounts of income taxes recoverable payable in the future. This was example number 1. Example 1, year 1, 2, 3. This was the situation. Deferred tax liability was being created, and in example 2, in period in respect of deductible temporary difference. Example 2 related to this. Then carry forward of unused tax losses. If you have unused tax losses, again, when you multiply those unused tax losses with the tax rate, this will generate the deferred tax asset. Why? Because this tax losses, whenever you earn profit in the future, so when these tax losses will save your tax in the future. So this will generate an asset. Of course, for the recognition of an asset, for the recognition of the deferred tax asset, there is a criteria that has to be fulfilled before recognizing that asset. But so far as the deferred tax liability is concerned, wherever it arises, it should be recognized. Then carry forward of unused tax credit. If there are any unused tax credit which are unutilized, just because you are not earning the profit currently, so that will also generate your deferred tax asset. Then is the definition of, further, we continue with the deferred tax. There are 2 reasons why taxable profits and accounting profits are not the same. Temporary difference and the permanent difference. We discussed at length the temporary difference. Why we termed it as temporary difference? Because this is temporary, this will be reversed. But there could be situation where this difference is permanent. What does it mean? It means permanent difference, see, amounts that represent income or an expense for accounting purpose, but are not allowable for tax purpose. Not allowable for tax purposes. Amounts that represent income or an expense for accounting purposes and also for tax purposes, but in different periods. They are allowed, but in different periods. Here, they are not allowed altogether. So that's why we term such differences as permanent differences. Here is an example, but this will vary from country to country. This depends on the tax law of that particular country. Client entertaining expenses might be permanent differences. A tax authority in a particular country may not allow such expenses, but as a businessman, you normally have to incur this type of expense. So this type of expense, when it is permanently not allowed, so this will become the permanent difference. Fines and penalties. If you have paid it to the tax authorities, normally it is not allowed as an expense by the tax authorities. But anyway, as a businessman, this is your expense. Then see here are examples of the temporary difference. We have seen the depreciation example at length. Then there are a couple of more examples. Certain provisions which are tax allowable only when the related expense is paid. Only the timing differences. Overseas dividends that are accounted for when receivable but not taxed until received. They do allow, but in different periods. So this is the basic thing. This was the difference. What is the rule of thumb for tax base? What does it mean? The points or the postulates which will be given under this heading that should be applied first. If a situation arises where any of these rules are not applicable, then you can go to the basic definition. What is the basic definition? Basic definition is very simple. Tax base, what is tax base? This is the amount attributed for tax purposes. Attributed for tax purposes. But I would suggest Alhamdulillah, having experience on the practical side as well, working practically on the financial statement as well, uh, being a partner of this firm. So I found these rules are very useful. Simply, if an account balance related to an income or expense which is allowed on cash basis, its tax base will be zero. Very simple. Simply see if an account balance means a figure appearing in the statement of financial position related to an income or expense. Of course, any asset or liability, if it relates to the income or expense, which is appearing in the income statement, if that income or expense will be allowed on cash basis, then the tax base of this account balance, either it is asset or liability, will be zero. Second is, tax base of permanent difference will be equal to its carrying amount. This is the second rule of thumb. Why it is equal? Because when you will make the carrying amount as per the accountant equal to the tax base, so no difference will arise. So for permanent difference, because that will not be reversed, so no difference should arise. Because there will be no deferred tax consequences if there is a permanent difference, because they are not allowing at all, not now, not anytime in the future. So this is a permanent difference. For permanent difference, remember, no deferred tax consequences will arise. Only deferred tax consequences will arise on the temporary differences. Okay. This is the second. So that's why, in order to make sure no difference should arise, we simply keep the tax base of the permanent difference equal to its carrying amount as per accountant. Then an account balance related to an income or expense allowed as it is, then tax base will be equal to its carrying value. For example, if revenue is allowed, this means the related account receivable, mean that portion of revenue which is not yet received from the customer is account receivable. So the tax base of that account receivable will be equal to its carrying amount. And number 4, if acquisition or repayment of an account balance does not in itself have any tax consequences. For example, you take a loan, so this will not have any tax consequences. And repayment of loan will not have any tax consequences. The tax base will be equal to its carrying amount. This is for the simple. This is where, like, this will not be applicable to the convertible loan. This is for the simple loan, like you have taken a bank loan at the market rate, and its fair value is equal to the consideration received. So this will be applicable. Otherwise, first of all, apply the rule of thumb. Otherwise, use this definition. So practically, in a number of situations, you can very easily apply these rules, except in few situations, you will have to go back to the definition. These rules are derived from the definitions, but these are shortcut. We shall be having a break of 15 to 20 minutes. Then we will be back and continue with our discussion. By the time, if you have any question, anyway, we shall be having not pop-ups, but I shall be asking you a couple of small questions related to the determination of the tax base. And this slide, which is now in front of you, will be helpful in answering that, so that we could have a little practice on this on these rule of thumb, which will be applicable to many situations. So Okay, welcome back. Welcome back. We were discussing rule of thumb, and we learned that if in any particular situation these rule of thumb are not straightforwardly being applied as it is if any particular situation has something in addition to what is mentioned in these rule of thumb. So straight away we will go for the definition. So now we shall start practice on this concept. The first one is, so I'm not making it as a pop-up question, but I would like you to answer these small practice questions. So all the respected members, please. The first small question is in front of you. Please, by applying the rule of thumb, you can answer these questions wherever rule of thumb is not applicable. So, of course, we shall be applying the definition. See, the machine cost 10,000. For tax purposes, depreciation of 3,000 has already been deducted in the current and prior periods, and the remaining cost will be deductible in future periods, either as a depreciation or through a reduction on the disposal. Revenue generated by using the machine is taxable. Any gain or loss on the machine will be taxable, and any loss on disposal will be deducted for tax purpose. So what is the tax base of this machine? Please. I'm waiting for your answer. What is the tax base of the machine? So you have 30 seconds to answer this. What is the tax base of this machine? Okay. Okay, time is over. The correct answer is 7,000. This was a very simple question because as you can see that for tax purpose depreciation is 3,000. This was the cost of the machine. So this means simply from tax point of view, the difference is the tax base. Then the second small question is interest. Whosoever answered uh, 7,000, that is correct. Okay, next is interest receivable has a carrying amount of 1,000. The related interest revenue will be taxed on a cash basis. What is the tax base of this interest receivable? What is the tax base of this interest receivable? Here you can straightforwardly apply the rule of thumb. Here you can straightforwardly apply the rule of thumb. Okay. Again, you have 30 seconds. Okay. What is the answer?
0.
Nil is the correct answer. See, if you go back to the rule of thumb, so I would recommend all of you that please, in most of situations, these I found myself practically that these rule of thumb are very useful. So instead of reinventing the wheel again and again, as I said earlier, please go to those rule of thumb and straightforwardly answer your text, because this will be allowed on a cash basis. So any thing which is allowed on cash basis, the related asset or liability, liabilities tax base will be zero. Okay. Next is trade receivables have a carrying amount of 10,000. The related revenue has already been included in taxable profit. This means that revenue is all allowable for tax purposes or tax loss. So what is the tax base of this trade receivables? So again, you have, okay, what is the answer? 10,000 is correct. Why? Because now I'll be referring to you, like here we have used the definition. Though rule of thumb can be applied, but that will be very difficult to apply here. Here we simply use the rule of thumb, which is number 1. And here we have applied rule number 3. Here we have applied rule number 3. Okay. Next is a loan receivable has a carrying amount of 1 million. The repayment of loan will have no tax consequences. What is the tax base of that loan of 1 million? Please answer now. This situation is also covered under rule of thumb.
$1 million.
1 million is correct. Again, here the rule of thumb is number 4. Please have a look at the rule of thumbs. As I said, in most of your situation, these rule of thumbs will be applicable in most of your situation practically. Okay, the next question is, dividends receivable from a subsidiary have a carrying amount of 5,000. The dividends are not taxable. Again, this situation is covered under the rule of thumb. The dividends are not taxable.
We have the answers.
Yes, please.
Nil, 5,000, 0.
The correct answer is 5,000, and this is related to rule number 2. Simply, see, this is a permanent difference because it is not taxable at all. This is permanent difference. This is permanent difference. Remember, the carrying value of an asset or liability, which is resulting from permanent difference, will be same. So its carrying value is 5,000, so its tax base will be same. The reason, though I have discussed the reason, but when we learned the rule of thumb, this relates to the rule of thumb number 2. Okay, let's move to the next slide. Current liabilities include accrued expenses with a carrying amount of 1,000. The related expense will be deducted for tax purpose on a cash basis. What is the tax base of accrued expense? I hope you people should now answer correctly because now we have started repeating those rule of thumb. Simply keep rule of thumb in front of you and see which one relates to this particular situation. Exactly, which should relate exactly to this particular situation.
We are getting the same answer now. That is nil, 0.
Nil is the correct answer because here this is covered under rule number 1. Wherever an income or expense is being allowed on cash basis, the related asset and liabilities tax base will be 0. So this is rule number 1. Okay, good. Appreciate it. Number 2, current liabilities include interest revenue received in advance. Current liabilities include interest revenue received in advance with a carrying amount of 10,000. The related interest revenue was taxed on a cash basis. So what is the tax base of this interest revenue received in advance being deferred revenue? So here you will be applying one of the rule of thumb. One of the rule of thumb. So you have a few more seconds, so please. Okay, what is the answer?
Majority are saying nil, but a few are saying 10,000.
It's good that we started appreciating the principles given in this rule of thumb. So this is covered under account balance related to income or expense allowed as it is. Acquisition. Okay, this number 3. This number 3. Okay. Now the next. Current assets include prepaid expenses with a carrying amount of 2,000. The related expense has already been deducted for tax purposes. Has already been deducted for tax purposes. Okay. The tax base is, please answer now. So what is the
2,000.
2000? Very right. Again here, number 3 will be applicable. Okay. Now, is current liabilities include accrued fines and penalties with a carrying amount of $100. Fines and penalties are not deductible for tax purposes. So what is the tax base for this? Okay, what is the answer?
100.
Most of them are saying 100.
Most of them are saying 100. A few have said nil.
100 is correct. See, this is again a permanent difference. This is covered in rule number 2. This is again a permanent difference. So we will have to keep its tax base the same in order that no difference should arise. No difference should arise. Because if there is a difference, so we will be applying the tax rate to calculate the deferred tax. So no difference should arise. So we will keep the tax base of an asset or liability which represents permanent difference equal to its carrying amount. Okay. Now, the next is loan payable has a carrying amount of 1 million. The repayment of the loan will have no tax consequences. Okay, please answer this. Okay, what are the answers?
1 million. All of them are saying 1 million.
Good. I appreciate tax base of the loan is 1 million. Again, here rule number 4 will be applicable. Fine. Let's move further. See, a borrower records a loan at proceeds less transaction costs. As we remembered, in case of financial instrument where you recognize that financial instrument at fair value less transaction cost. The carrying amount of the loan is subsequently increased by the amortization of the transaction costs against accounting profit. The transaction costs were, however, deducted for tax purpose in the period when the loan was first recognized. So here we are moving into more practical and different situations. Like from accounting point of view, what you do, you deduct cash received with like transaction cost, and you amortize this transaction cost over the period of the loan, whereas tax people allows you this transaction cost in the year in which you obtain the loan. So again, this will create a difference. A loan payable is measured on initial recognition at net proceed, net of transaction cost. The transaction costs are amortized to accounting profit over the life of the loan. Those transaction costs are not deductible in determining the taxable profit of the future, current or prior period. So these are the permanent differences. The liability component of a compound financial instrument. We shall be discussing it with the help of an illustration as well, is measured at a discount to the amount repayable on maturity after assigning a portion of cash proceeds to the equity component, as we discussed under IAS 32. The discount is not deductible in determining the taxable profit. Tax people cannot understand the concept of bifurcating between the equity element and the debt element. They cannot understand this. So simply what the amount you receive, they will be treating it as a loan, straight away loan. So this will create a difference. So we shall be discussing it with the help of an illustration. Similarly, current investments or financial instruments are carried at fair value. This exceeds cost, but no equivalent adjustment is made for tax purposes. Property, plant, and equipment is revalued, but no equivalent adjustment is made for tax purposes. This also applies to long-term investments. So this way, difference arises. So first of all, normally we have the accounting figures with us, because when we prepare the financial statements, we prepare those financial statements in accordance with the applicable financial reporting standards. So this is quite normal. So what we need to do, we need to calculate the tax base. So first of all, apply rule of thumb. If any situation is not specifically covered by those rules, then go for the definition. So let's try with the help of a scenario. Okay, you have with you this situation. Let me okay, this illustration is available with you. See, this is the company. These are its financial statements. These are its financial statements. Okay. So say I pick 2005. I want to calculate the deferred tax related to 2005. The same principle will be applicable to 2006, 2004. So if you see, this is a complete balance sheet. Both sides tally. So what it says, income tax rate in 2005 is 40%. Charitable donations are recognized as expense when they are paid and not deductible for tax purposes. Company paid donation 500 in 2005 and 350 in 2006. In 2005, liability of 700 was recognized as fine, which is not deductible for income tax purposes. Product development cost is deductible in tax on cash basis. In 2002, 1250 were incurred. These are amortized over 5 years. No payment regarding healthcare facility was made in 2005 and 2006. These are deductible tax in tax on cash basis. Depreciation rates like building, tax rate is 10% straight line, accounting is 5% straight line. Motor vehicles, tax 25% straight line, accounting 20% straight line. Full year depreciation is charged in the year of purchase, and these are the balances given here. So these were the addition. Like you can see that In 2005, there is an addition of building. Then something happened in 2006 because we are not focusing on 2006. So that's why. Calculate current deferred tax expense and provision for deferred tax liability or asset. Calculate the deferred tax expense. Though it only requires calculation of the deferred tax expense for the current year and the cumulative deferred tax liability at the end of 2005. But with the help of these figures, I will try to explain that the whole procedure which you should apply while determining the income tax expense and the current tax payable and the related deferred tax asset or liability. See, assume that these are the accounts in front of you, and this is the profit related to the 2005. This is the profit related to 2005. Okay, let me open it. Okay, 2005. So what we learned, let me mention over here. I can use pen from here. Yes, it is there. From here. I suppose I can use pen. Okay. No, I cannot. Check whether I can use pen from here or not. Let me please excuse me by the time I set my pen here. Okay, I suppose inshallah it should work. Not still working. Okay. So what I can do, I can use its solution, but it should work. Without that, see for year 2005. I will keep my balance sheet in front of me and see what is the tax base of various assets and liabilities. See, in 2005, receivables tax basis, its carrying amount is 500 and its tax base will be 500 as per rule of thumb. As per rule of thumb number, I suppose 3. As per rule of thumb number 3, which says an account balance related to an income and expense. This account receivable related to the revenue, and that is allowed as it is. So that's why this receivables tax base will be the same as its carrying value, because the related revenue is allowed as it is. So its tax base will be 0. The difference will be 0. Inventory. The same rule number 3 will apply to the inventory. The same rule will apply to the inventory. Then product development cost. If we just go back to our question, you can see that here about product development cost. In product development cost, it is mentioned here, product development cost is deductible in tax on cash basis. We learned in rule number 1 that if something is allowed on cash basis, the related asset will be the tax base of the related asset will be 0. So it is 0. here, product development cost. Then is the investment. Here, rule number 4 will be applicable. If you have invested and tax people do not have any problem, so no difference will arise. This will not have any tax consequences. Then property, plant and equipment. 37,200 is given here in the question. See, here in the question it is given. 37,200 it is given. What you did, you calculated the carrying amount as per the tax people by using this information. Like for building 10% straight line, and for motor vehicle 25% straight line, and the cost was 50,000, and accumulated depreciation for tax purpose on building was 40,000, and for motor vehicle it was 5,000. So this will give you 12,900. So this will create a difference of 24,300. Then comes the liability. Payables, same principle number 3 will apply because the expenses related to this liability was allowed as it is, though it is not mentioned in the question, but we are assuming that. Normally, if nothing is mentioned in the question, like about the receivable, we know, like in almost in all countries, if that revenue is allowable as it is, then if any receivable related to that revenue, or if an expense is allowed for tax purposes, any accrual related to that expense will have the same tax base as its carrying amount. Fine. See, fine. For fine, we can go back to the question and see what is written over here. It is written that fines are 700 was recognized as fine, which is not deductible for income tax purpose. This means this is a permanent difference. So for permanent difference, we learned its tax base should be 700. So healthcare facility, we can see what is written here about healthcare facility. It is mentioned here, healthcare facilities. No payment regarding healthcare facility was made in 2005 and 6. These are deductible in tax on cash basis. Again, something which is allowable on cash basis, the related asset or liability, tax base will be 0. So again, this is 0. So long-term debt, here again, principle number 4, rule number 4 will be applicable. So here, these are the differences. So 250 here, 24,300, and this 2,400. So this positive represents taxable temporary difference, and this negative represents deductible temporary difference. When you multiply it, the net of these, this will give you the 9020. This is the closing balance of the deferred tax liability at the end of 2005. Closing balance of the deferred tax liability at the, please remember this figure. So we come back because I hope I can write something over here. So this was 9020, closing balance. Closing balance. Okay. So if we prepare an account of a deferred tax account, what was the opening balance? We can see it from like on the question. Here is the question. We can see that this was the opening balance, 8,600. 8,600 was the opening balance. We calculated the closing balance. It is also mentioned on this balance sheet because this balance sheet is after the effect of tax calculation, after the effect of tax calculation. So now what will happen? The difference between these two. See, in the absence of any other factor like revaluation or things like this, in 2005 there is no revaluation. If nothing happened except this passage of time, the difference between 8,600 and 9020 will become deferred tax liability for the current year, 420. So this means for current year, your entry will be credit deferred tax liability account, liability or deferred tax account 420. And what about the expense? Profit and loss account, income tax expense. And then there will be a current tax payable, current tax payable, current tax payable. So I hope you understand how we calculated this 420. Before I move and explain you or remind you about the discussion of current tax payable, so please, if you have any question, Mr. Bilal, if you have any question, please feel free to ask now related to particularly to this question. Because see, suppose that this is your company and this balance sheet and the related information related to your company, and now you are sitting just to think what could be the journal entries. Though those journal entries have been passed in the preparation of these balance sheets, so that's why though we calculated this 9020 independently, but it is already there in the balance sheet. This means the effect of the deferred tax, current tax, and income tax expense is already included in these financial statements. We are only trying to understand what were those entries which were passed regarding income tax expense, current tax payable, and deferred tax liability. Further, how were these figures calculated? So again, I'll be discussing with you a rule of thumb, or you can say that a tip related to the income tax expense calculation. Though during our previous discussion, we just learned that okay, apply tax rate to the accounting profit, but as we go by and when we talk practically, so you need to adjust a couple of things. Then that profit can be used for the calculation of the income tax expense. And about current tax payable, we learned that when you apply the taxable profit with the tax rate, this will give you the current tax payable. So, please, if you have any questions.
We have one question only, that is from Rizwan Khan Afridi. He asked why the tax base is 0 in case of cash basis.
Who is this gentleman?
Rizwan.
Rizwan, see, the logic behind it. See, if you have like an expense of 200, an expense of 200, and you have not paid anything. So in balance sheet, what will be the effect? The effect will be there will be accrued expense 200. Tax people will not allow this expense here. Okay, so this means a temporary, they will allow when you will actually pay the cash related to this expense. So this means this will create a temporary difference. So in order to create that temporary difference in the balance sheet, the tax base of this accrued expense will be 0. Mean simply from tax point of view, they do not agree on this expense. How can they agree on the accrual of that expense? So from tax people point of view, this accrual expense will be 0 because they are not allowing this expense. So that's why, Mr. Rizwan, we have taken it as a 0. So I hope it should be clear.
We have another question from Fateh Muhammad. He's asking, do we suppose that the accountants knowledgeable of the tax law requirements and hence they would be able to calculate the current income taxes and DTA as well as DTL?
Okay, can you please tell me your country of residence so that I could answer more specifically?
Next is from Rashid Hanif. He's asking, please show calculation of tax base of PPE.
Property, plant and equipment. Rashid, see, I'll be sending you the answers. Uh, so you can do it yourself. Otherwise, if I'll start, it will take at least 15 minutes because, due to usage of screen, my speed is slow, but I want to discuss certain more important aspect. You can do yourself. It will be the same, and I'll be sending all of you the answers. Khadir, responded?
No. Fatih, can you please respond with your country name? Fatih Mohammed Fakhri. UAE.
Fateh, you are very right. Because here in Pakistan or India or Bangladesh or Sri Lanka, so far my information is concerned, an accountant must have the knowledge of tax. Normally, an accountant without tax knowledge is considered as a lion without teeth. So because you are living in UAE, so now they have started talking about on the tax, but in the rest of the countries, this is quite obvious that an accountant will have a good grip on tax because he must know when he will have to deduct the tax from the payments he is making, how he will prepare the monthly income tax return and the sale tax return and the annual return. This is a part and parcel of an accountant's job description in most of the organizations. Next.
That's it.
Okay. So, income tax expense and current tax payable. If you go back to our question, so here you can see that the profit is 8775. This is the profit. So I can keep my question here in front of me. So I can use this slide. Okay. I want to change the color. Color I use is black. So what is accounting profit? Accounting profit is 8775. Okay. Now we'll make a couple of adjustments. I will divide my adjustment into the permanent differences and temporary differences. Permanent differences and other adjustment. Okay. I'll start from my question. See, it is mentioned here, income tax rate is 40%, fine. So I'll mention here 40% during 2005. Then charitable donations are recognized as expense when they are paid and are not deductible for tax purposes. Cash paid in 2005. 500 they have paid. So I will reverse that. This is a permanent difference. 500 donation. This is not allowable. Donation is a permanent difference. They will not allow now or any time in the future. In 2005, liability of 700 was recognized as fine, which is not deductible for income tax purposes. This is again a permanent difference, 700 fines. So these two are the permanent differences. Then we move further. Product development cost is deductible in tax on cash basis. This was incurred 1250 was incurred. These are amortized over 5 years. So this is the temporary difference. So I'll be reversing from here because the whole amount was allowed in 2002. So 250 will be reversed from this profit. Product development cost. Then is no payment regarding healthcare was made in 2005. However, in 2005, healthcare expense as per the question is healthcare liability, though nothing was paid, but healthcare liability is there. In 2005 is 2000. So I shall be reversing this 2000. Because tax people will reverse it. Healthcare facility. Healthcare facility. And then what else is there? Of course, they will reverse accounting depreciation. Accounting depreciation. Accounting depreciation. What is the accounting depreciation? Let me check if I have calculation ready with me. Okay. What they will be doing, they will be adding back. They will be adding back the accounting depreciation. And they will be allowing tax depreciation. This means I am representing tax depreciation with triple Z. So say this amount comes to AAA. So this is in fact taxable profit. This AAA. So this AAA will be multiplied with a tax rate of 40% to give you the current tax paid. So this will become your balancing figure. Or if you want to calculate this figure directly, you can calculate this figure by adjusting the accounting profit with permanent differences. You can calculate this figure. See if we try from here. Try to calculate this figure from here. 8775. This is total is 9975. When we multiply 9975 with 40%, which is the tax rate for this year, so this will give us 3990. 3990. 420 for deferred tax and 3570 is the current tax payable. We can see from our balance sheet as well. So it is written here. See, 3750 current tax payable. This is the presentation. This is the current tax payable. This is the closing balance. And this is the journal entry. This is the journal entry. If you people have any question, so this is to greater extent the whole picture. In every year, you have to pass this entry. Okay. If you do not have any question, we can move further. Or in order to see what we have discussed, you can go back and see the recording. Okay. Now we move further. Another illustration number 2. See, this is the, you can go to the illustration number 2. Here is illustration number 2. Illustration number 2. Okay. This is the situation. And these are the figures. See, again, this illustration relates to the consolidated financial statement. This illustration relates to the consolidated financial statement. Assuming you are an accountant of a group of companies. So this is the situation. Again, see the most important aspect is the determination of the tax base. So in this example, we are moving towards the more complex concept, whereby hardly you will be able to apply the rule of thumb. So there, of course, we will be going back to the basic definition. The following information is relevant to the above statement of financial position. The financial assets are classified as investments in equity instruments and are shown in the above statement of financial position at their fair value on 30th June 2010. The cost on 1st July 2005 was 9 million. Taxation is payable on the sale of asset as allowed by IFRS 9. An irrevocable election was made for changes in fair value to go through other comprehensive income, not reclassified to profit or loss. The stated interest rate for the long-term borrowing is 8%. The loan of 10 million represents a convertible bond which has a liability component of 9.6 million and an equity component of 0.4 million. The bond was issued on 30th June 2006. The tax basis of the assets and liabilities are the same as their carrying amount in the draft statement of financial position, except for the following: property, plant, and equipment. It is given trade receivables, other receivables, employee benefits. So if we look at the answer for this, other intangible assets were development costs, which were all allowed for tax purpose when the cost incurred. Okay. Trade and other payables includes an accrual for compensation to be paid to employees. This amount to 1 million and is allowed for taxation purposes when paid. Goodwill is allowable for tax purposes in this jurisdiction. See, this was their balance sheet. This was their balance sheet. And see, this is first column is the balance sheet. What we did in the next column, we put the tax basis for these assets and liabilities. In case of property, plant, and equipment, tax basis given. For goodwill, because this is a permanent difference, as it is mentioned, this is not allowed. Mentioned goodwill is not allowable for tax purpose in this jurisdiction. Something which is not allowed is a permanent difference, and we learned in rule number 2, rule of thumb, that for permanent difference, the tax base will be equal to its carrying value. So that no difference should arise, in fact, because differences should only arise because here it is clearly written temporary differences. So that's why we keep it the same. Other intangible asset, 0. Its tax base is 0. In case of other intangible assets, because it is written, these intangible assets were in fact the development cost. These were allowed when incurred. This means from tax point of view, its tax base will be 0. Okay, and here again the rule of thumb will apply. Okay, then is financial asset. In financial asset, we can see that it is mentioned over here regarding financial assets that financial assets are classified as investment in equity instruments and are shown in the above statement of financial position at their fair value on 30th June 2006. The cost on 1st July 2005 was 9 million. The taxation is payable on the sale of the asset as allowed by IFRS 9, and irrevocable election was made for changes in the fair value to go through other comprehensive. So its cost was 9 million, but entity was applying IFRS 9, so that's why they increased its value to the fair value, which is mentioned over here, like so 10,500, but its cost is 9,000. For tax people, they do not understand this fair value measurement, so they will treat this financial asset as they will take it as at its cost. So this will create a difference of 1,500. Then is the trade receivable. See, here it is given in the question that the trade receivable tax base is 7,500. We use the same. And other receivable tax base, I suppose it is also given in the question, which is 5,000 and employees benefit 5,000. Both are given, and we have taken from here, like other receivable 5,000 and cash equivalents. The tax base is the same because this will not create any temporary difference. And then comes the long-term borrowings. See, long-term borrowings. This is in fact the convertible. What you did, I suppose it is convertible. Let me go back to the question so that I could see that whether it is because of transaction cost or it is convertible. See, it is written here, the stated interest rate for the long-term borrowing is 8%. The loan of 10 million represents a convertible. Yes, it is convertible, which has a liability component of this 9.6 and the equity component of 0.4 million. But the tax people will take it as a 10 million. They do not, tax law do not take into account what are your accounting principles. So though accountant has prepared the balance sheet and he mentioned here 9.6 million, but from tax people this is 10,000. So 400 difference will arise on this convertible loan. So here you have applied the definition, very simple, but it is rule number 4 as well. From tax point of view, this is simple, 10,000. So whereas from accountant point of view, it is 9,600, but this difference is a temporary difference, so this will disappear. Deferred tax liability, we have taken the same, but we are trying to reach this figure. I suppose no. This is I suppose opening liability, employees benefit. This tax base is given in the question, so this will result in 480 difference. Current liabilities, nothing is mentioned. Then normally we take current assets or current liabilities as if they are having tax base equal to their carrying amount. Then trade and other payables. It is mentioned that 1 million is included in this amount, which will be allowed. Sorry, which will be allowed when they actually pay the cash. So for that 1,000, the tax base will be 0, and the remaining 4,000, so tax base will be equal to its carrying amount. So this will create a 1,000 difference. When we net off all these deductible and taxable temporary differences, this will give us 1,308. And when we multiply the tax rate on this, this will give us the closing deferred tax liability. If you people have any question related to this illustration number 2, see again, the whole concept is the determination of the tax base. If you are in a position, or if you can understand how to calculate tax base correctly, this means you have done your job, because the remaining task is not very complex. You will have to calculate tax bases, differences. Calculation of difference is only a mathematical calculation, and applying tax rate, this will give you the closing deferred tax liability. And so far as the current tax payable is concerned, it's a very simple. Take your accounting profit, make adjustment within that profit, and make it taxable profit. Apply the tax rate to that taxable profit. But you see, this taxable profit is very simple, because all accountants in most of the countries study tax. Though you people might have studied in ACCA tax, but that tax, I suppose, relates to UK. But normally in other countries, even under ACCA, you people study local tax. And when you work practically, because from the first day you have to deal with the tax, so that's why you normally know those principles, or the list of those expenses which are allowable, which are not allowable, and where temporary difference will arise, where permanent difference will arise. Normally, these people have all these understandings, so they can calculate from their accounting profit the taxable profit, and then they can apply the tax rate to this taxable profit in order to calculate the current tax pay. So the income tax expense will be the balancing figure. Otherwise, you can calculate income tax expense by adjusting your accounting profit with the permanent differences and then applying the tax rate to that amount. This will give you the income tax expense. So this is the whole story. This is the whole story. Though we can even this illustration relates to the consolidation, but the whole story is about these three figures that every year you need to see what is your deferred tax related to that particular year, and current tax payable or current tax and income tax expense. The whole standard moves around these three things. Okay, do we have any question? Yes, please.
First is from Cheyenne Qureshi. He asked how the difference of issuance cost of liability shall be reversed.
Cheyenne, that difference is in fact uh, incorporated in the calculation of the amortized cost. So when you unwind your amortized cost over the years, so that will be accounted.
Next is from Muhammad Fahim Islam. What is the impact of deferred tax goodwill?
Because in this illustration number 2, goodwill is not allowable, so this will not affect deferred tax.
Next is from Fahim Islam as well. For consolidation, deferred tax liability will be calculated on consolidated accounts or for parent and subsidiary companies separately.
You can, it depends on the, but in fact, on consolidated financial statement, because we are talking about International Accounting Standard 12 and the IFRS, so you will be doing this practice on the consolidated financial statement. Of course, separate financial statement will have their own calculations of the deferred tax.
Next is from Nasir Ali. So any book you will like to mention for us to understand the Pakistan situation?
There are many books, but I found it is better you should use the original income tax, because being a member, you are in a senior position, so it is better you should directly refer to the original income tax for various matters. Anyway, there are a couple of books available in the market, like the most easiest from student point of view is the Patiwala book, tax ordinance. Every year it is updated. Then Mr. Munawar Mirza book is available. Then there are a couple of books are available, but in all these books, the easiest one from student point of view is Patiwala book. But I would recommend, being a member, you should develop your repo with the original income tax expense. That is, original income tax law, because that is not very difficult to understand. Once you are used to it, you will be enjoying it. So this will help you in understanding very easily whatever changes are announced every year. So you will be able to appreciate those changes directly while listening to the budget. So I would recommend that you should use income tax law, original income tax law. Next.
Then we have a lengthy question from Shahid Aslam. He's asking if an ABC company has a history of calculation of its current tax liability under Section 113 Minimum Taxation of Income Tax Ordinance 2001. Since many years, almost 7 years, calculation of minimum taxation is always higher than the calculation of taxation on taxable profits. The company has history of taxable profits with no unobserved loss. Whether the company shall calculate deferred taxation in financial statements, although there are temporary differences under different account heads. As per my understanding, no temporary differences are accounted for in financial statements and in income tax return.
This is who is this gentleman?
Shahid.
Shahid, see, when you pay minimum tax, you know, but again, I'll not go into any detail because this is related to Pakistan only, and we have other members as well. But anyway, see, in Pakistan even, uh, there is no time limit for claiming your uh, tax depreciation. So this means any deferred tax related to your tax depreciation will be reversed whenever you are in a position to earn profit, which will take you above your minimum level.
Next is from Johari Lal. He's asking, my question is with regard to deferred tax assets. If it is anticipated that there is a remote probability of profit in future, can we record deferred tax assets in case of net deductible difference aroused? Arise?
Johari, you are very right. We shall not be recognizing that asset because for asset the rules are stringent. For example, deferred tax assets are only recognized to the extent they are recoverable. Uh, this will be the case if it is more likely than not that suitable tax profits will exist from which the reversal of the timing difference giving rise to the asset can be deducted. Okay, so you are right, Julie.
Next from Muhammad Mansoor Khan. He's asking, please ask Mr. Abu Bakr to arrange a significant VAT as VAT is going to implement in UAE from 1st January and need his professional lecture on this topic.
Mr. Mansoor, your request has been noted. So,
I'm sorry, sir, if I'm interrupting. I would recommend that you talk initially to Mr. Haruna Majan, right? Writing in detail that why we think that this is an important topic and why we should cover this topic. So, write a suggestion to Mr. Haruna Majan so that he can arrange on this topic.
Mr. Mansoor, further, what I can remember, this sort of session is already planned. So, as Mr. Bilal said, when you will be writing to Mr. Harun, hopefully he will be able to give you a very specific answer to this about when it is planned and who is conducting and all these things. Next.
That's it for now.
Okay. So, so this was the illustration number 2. Now we move next. See, though we have discussed the business combination, so there are certain circumstances that give rise to the taxable temporary differences. So we have discussed these about these business combination. All these are the situations where these will give rise to the taxable or deductible temporary differences. Here is a list of those circumstances. Then again, this is a list. And here are 2 small illustrations, which tells you how to account for those differences. But I shall not be discussing these illustrations because we have seen a very detailed illustration just now about consolidated accounts. I would like to utilize this time for the purpose of the explanation of specific implications on other standards of this International Accounting Standard 12. So this is from my book. I have not extract, but I have opened here a part from my book. So here you can see that for leases. You might have leases on your balance sheet. What will happen when you have leases on your? Okay, let me see where we were. Leases. It should be, I think, on 4.1. Yes, here are the leases. In case of finance lease, tax authority allow periodic lease installment as an expense for that period, whereas International Accounting Standard 17 requires the installment to be bifurcated. Likewise, even under the new standard, the same is the thing between finance cost and the repayment of the lease obligation. This difference of treatment will create deferred tax. So take it as if it is same for IFRS 16 as well. This difference of treatment will create deferred tax base of account balances. So this way you will, while using balance sheet approach, this way you can calculate the deferred tax related to this particular transaction. But however, if you are calculating the tax base for all the assets and liabilities mentioned on the balance sheet, so within those assets and liabilities, of course, lease assets and liabilities will be treated like this. Like in non-current assets, you will find leased asset, so its carrying amount will be AAA, but its tax base will be 0 because tax people do not take it as your asset. So they take it that this is in fact related to someone else. It should not be on your balance sheet. So temporary difference will be equal to the carrying amount. Likewise, under lease obligation, you normally divide it under two headings. You normally write it under two headings: non-current liabilities and then current liabilities. For both, they take their tax base as 0. So the net of these three figures will become your temporary difference. So this will be either deductible temporary difference or taxable temporary difference. But here you can see that here this will create, because here the carrying amount of the asset is higher. So we learned the rule, this will create a deductible temporary difference. Here this is a liability, the situation will be reversed. So this will be a deductible temporary difference. This is again the deductible temporary difference, applying the same rules for higher or lower rule for carrying amount in the tax base. So this will give you the deferred tax related to the lease if you want to apply the balance sheet approach. But if you want to calculate the deferred tax effect related to this lease from income statement, so what you will be doing, this is your accounting profit, add depreciation back on the lease as because tax people do not take it as your own asset, so you cannot recognize this depreciation from the tax people point of view. It is not like that they will be allowing a different date. They do not allow this asset altogether. So that's why they do not allow its depreciation as well. Then you will be adding here the finance charges, because they do not allow this finance charges as well. Simply they allow whatever amount you actually paid during the year. They will allow this amount as a deduction from your profit. So this will be the taxable profit, assuming that there are no other differences. But anyway, if there are other differences, so these three adjustments will be related to the leased asset. So this was related to the leased asset. Next is, this is an illustration, but we cannot discuss it because of shortage of time. I want to discuss another aspect. So this material is from my book, which is available here in Pakistan from Wahid Book Depot. But anyway, compound financial instrument. One of our respected members asked a question when we were discussing about the compound financial instrument. He wanted to ask about the deferred tax implication. So it is included in this book. Anyway, I'll try to discuss it quickly. A compound financial instrument are split into equity and liability components and presented accordingly in the statement of financial position. The tax authorities do not allow the entity to claim any deduction for the imputed discount on the liability component of the instrument. This difference of treatment will create deferred tax liability, as we have just seen, like in illustration number 2. There was compound instrument, hybrid instrument, mean convertible. Tax people were saying you received 10,000, fine. For us, this is 10,000. But the company bifurcated it into debt component 9,600 and the 400 equity component. So as a result, 400 was the temporary difference. So what will be the double entry for this? Here is an illustration, and double entry is this. So you have received 1,000 in this example, and this is deferred tax debt component, and this is equity component. And this will be the deferred tax liability. How it is calculated? How it is calculated? If we just look at it, if you just look at the illustration says an entity received a non-interest bearing convertible loan of 1,000 on 31st December 2014, repayable at par on 1st January 2018. The entity classifies the instrument liability component as a liability and the component as equity. See, here they bifurcated this 1,000 into 751 and 249. This is the tax rate. But tax people say no, this liability is 1,000. So the difference between 1,000 and the 751 is 249. So they calculated temporary difference in this at the rate of 40. So this will give us 99.6. So this means this 100. This 100 will go to the deferred tax liability. Then I'll be sending you its answer. Year by year, I have shown the calculation within this book that how the carrying amount of this liability and the tax base will affect our deferred tax calculations year by year basis. So this is all about from my side, and this was our last session. And these because these slides and other material will be sent to you by our ACCA friends. So over to Mr. Bilal, if you have to run in poll or anything like this.
No, that'll be all. I believe if you guys have any questions, you can quickly put it up on the questions pane so that we can ask it to Mr. Abu Bakr. If you have any questions regarding particular sessions, it would be great if you can drop us an email and we can respond it to you. We have one comment from Mr. Imran Samad. He's saying, Dear Mr. Abu Bakr, many thanks for all your efforts in arranging these sessions. This is certainly a very hectic job, especially when your audiences are not in front of you.
Yes.
You have outperformed, and I hope you would continue these sessions. Appreciated. Thanks to ACCA Pakistan, and special thanks to Mr. Abu Bakr.
Thank you very much, Mr. Samad. I am really obliged. Thank you very much.
And then we have thanks from Fateh Umar, from Dishan, from Asad Ali, from Fateh Muhammad Fakhri. Yeah, a lot of praises for you.
Thank you very much. Thank you very much, all of you. But even if you have any question related to any standard, so you can send me an email, but be patient because due to other busyness, I may be able to answer those emails maybe after some days. So whenever I find time, but anyway, you are welcome. If you have any question which you feel that you can wait for a couple of days, that then you can send that question through your email as well. Thank you very much.
Thank you so much for joining us, and take care. Allah Hafiz.